All right. Well, good morning, everybody. Welcome to another edition of Mastermind. Today, Anthony is with us, one of our awesome partner lenders. It came up that um, because of a deal one of us did, it would be a good idea to talk about condos and lending. If you haven't done a condo yet, then you definitely don't know what you don't know. And it's best to know a little bit before you get too far down the line with someone looking at a condo or that's considering a condo as an option. So I'm going to turn it over to Anthony here so he can give us some insight on what to look for to help make sure that you and your client are prepared when you're searching for condos, the information you need more than anything to prepare for the process to make sure you don't get your client in a situation where they lose money because you make an offer on something and then you didn't do your due diligence with the lender and then the lender can't finance it. So without going much further than that, I'm going to turn it over to Anthony and let him talk to us.
Good morning. How's everybody doing?
Not
Doing
good.
great.
All right.
Good. Good. So yeah, like Doug said, we had some, I guess, not really issues with one, but it's just a lot of the times it's what we can do before we even put in an offer, you know. So I'll just get right into it. There's like five things that every bank cares about. It's owner to occupancy ratio, which means how many of the units are rented versus how many of and this is very confusing because I can own a condo and rent it out, but I'm still the owner. It's not the actual HOA or the actual condo project that owns them and rents them out like an apartment. So owner to occupancy ratio. So I can own my condo and rent it out Airbnb, I can VRBO, whatever, but I'm still an owner of the actual condo. So that's the big thing. So if over 50% of them are owned by, it becomes by the entity itself, it becomes an apartment or a condotel. So that's one big thing to look at, and that's very, very rare that you'll come across that. That's more of like New York City or Chicago, Miami, stuff like that. Here's a big one. How much money do they have in the HOA budget? So if the roof flies off, do they have enough to cover the insurance deductibles? Do they have proper insurance? Things like that. That's a big one. And then, of course, are they getting sued by anyone inside of the HOA? Is any of the owners unhappy with, maybe the shared stairs? Or do they want it done before they'll pay their HOA dues? How many people are behind on their HOA due payments? But that's pretty much it. All of that information can be found out before we even put in an offer. And if you guys are ever really questioning about that, I can give you an HOA questionnaire. You can take it to the HOA president, and say, hey, can you fill this out before we go any further? I just want to see what the status is of the HOA. And that's it within every borrower's right to ask that, because once we get that filled out, it makes it so much quicker on the lending side versus getting to day 14 and saying, hey, fill out this questionnaire for us. So we can get all of this information in the beginning. And a lot of times the listing agent will have most of this information and they can fill out the questionnaire. It just has to be a representative of the project. Now, they can lie on these, which we've come across, and then we go to look at bank statements and, they say, hey, we have 50 grand in reserves, but they only have 10 grand. Now that becomes a big issue. And it's not really an issue. We could still finance that. You need to be sure that you're doing the right thing for your client, but it becomes the issue of how much is that loan going to cost your client? Are we, at 7.25% right now, but hey, you know what? This falls into a lesser tier, more risky loan because they don't have a whole bunch of money in the reserve account. Well, now that loan is either going to cost them, 3 grand to get to that rate, or the rate jumps up to 7.8. With like your ones that are about to fall into the ocean, those have got rates of 8.5 to 9% because they're riskier loans. So that's a big thing. And we really need to make sure that we know all the information up front, and we can only go off of what the HOA provides us, but it gives us a better idea of how hairy it is, how much difficulties we'll have with that. But any questions about the prerequisites, and then I can get into some other things. I mean, because those can be very, very confusing, especially with the owner occupancy. You can rent your condo, but you have to own it. So any questions on that?
Anthony, I do have a question. I've sold a pretty decent amount as the listing agent and the buy side of non-warrantable condos in Raleigh. I'm not sure how much you deal with that. A
Yeah.
lot of the times, one thing that you touched on, which I've dealt with a lot, is a preponderance of units being tenant occupied, not owner occupied. But the other thing that we deal with here, especially in downtown areas, downtown Raleigh, most of the condos and some of them in downtown Durham, they're non-warrantable because they have so much commercial space. And like, I guess it was always explained to me like PNC Plaza downtown Raleigh, probably the most popular, they're non-warrantable. You can still get loans for them, of course, like you mentioned, but I guess there's a master association that the commercial and the residential associations pay into. If we have COVID and all the law firms and restaurants go belly up, the commercial can no longer, they're not collecting lease money and dues, so they can't pay into the master, which creates a problem. The biggest problem that I've had with these transactions are, not to sound like it's not, but most agents don't know what they're talking about and they don't even know to check for this stuff on the listing side. And then, you have, again, not to sound like a jerk, but everyone on here has probably dealt with this. You have the HOA contact that works at a property management company that's managing like 700 doors or 5 or 6 neighborhoods, and they have absolutely no clue. And sometimes, especially when the market is busy, time is of the essence. Have you ever had any success of, or do you have any kind of database or anything that you have at your disposal, like maybe Fannie Mae or Freddie Mac or something, where you can look into and say, okay, I've got this property that's in this community. Do you have any ability to go back and check prior transactions that maybe you
Yes.
have or you have not been involved with to save us time because people just
Yeah.
don't know?
So that was what I was going to get to next was warrantable versus
Okay,
non-warrantable.
sorry.
And the big thing with that is the commercial space, yes. And that's where a if a HOA has a reserve study, that helps out a whole lot with that. It's
Okay.
gonna it's expensive for an HOA to get that done, but it allows them instead of like, hey, this property should really have 20% per year in reserves, but they don't. They only have 12%. You know,
Mhm.
that covers that as far as the commercial space. But as far as the non warrantable, like this property we in question that Doug was talking about actually got rejected on a conventional. What that does is it pings Fannie's blacklist. They're not supposed to call it a blacklist because that's kind of sketchy, but it literally goes on a list and it says, hey, this thing got rejected because of structural, or it got rejected because not enough money. Whatever the case might be, it gets pinged. So the short answer is yes.
Okay.
And that's what filling out questionnaire and submitting it. I'll submit a condo to 3 different lenders and say, hey, which one of you likes it the most? And I have a bank that's the most lenient, and I have a bank that's a little bit more strict, but it'll get a better rate for your buyer. If we have something that we already are feeling a little washy about, and the client's in good financial standing, then we're probably going to go to the bank that's a little bit more lenient. We may get charged an eighth, a half a point, but if it's a good investment, what is a couple $100 a month compared to getting that deal and getting it done? Then we can refinance down the road and say, hey, let's save some money here and see if we can't get a better loan product, because time is not of the essence at that point. So, but yes, there is a list that Fannie Mae keeps. Freddie doesn't keep that list, but Freddie refers to Fannie's list in a lot of the senses. So, like the project that we're working on now, that whole project, in order for it to come off of that Fannie list, is going to have an engineering report done. It's going to cost them a bunch of money. It probably won't happen, or we can wait for the inspection to time out, which I think is going to take another year and a half. So that's the big thing, for everyone in any project is we don't want to reject a loan. If we get a loan rejected, that is the worst thing that could absolutely happen, because we have the bank has to say why, and if it goes on that Fannie non-warrantable list or has whatever issue, Every time somebody tries to get a loan, it's going to be ping. Now, they may still be able to get a conventional loan, but they're going to want to see whatever report, whether it be a reserve study, um, engineering report, you know, how many, we need to get some of these units sold and out of the HOA or condo group's name and sold to individual parties, whatever that case might be. So, but
Okay.
yes, there is.
Not to dominate, I'll be brief, but you and I have not had a chance to chat yet. I'm sorry about that. So you're a mortgage broker, correct? It
Correct.
sounds like you have the ability to shop these loans around to various people. And so it sounds like if you're in the weeds with someone and we find out late in the game that a condo is non-warrantable, you can find a product for that. And if I'm hearing you correctly, it sounds like the difference between a warrantable and a non-warrantable is typically an eighth to a half a percent difference in interest rate.
For a really, really qualified borrower who has
Okay.
25% to put down.
Okay.
Yes, but I mean, and there's different levels. So the riskier the home, no money is free. So the
Right.
riskier the unit that we're selling, the higher the rate is going to be. Like what are the ones that are about to fall in the ocean? We can get a loan on that, but it's probably going to be in the nines. It's going to be ridiculous because they're going to get penalized. And when
Right.
you're at a rate that high, you have to have more skin in the game. You have to be more of a qualified buyer for it. But we can still, instead of having to purchase the whole thing, you may only have to finance, 30 or 70% LTV or something like that. So you can still keep some cash in your pocket. But yes, there is always a way, unless it's litigation, like extreme safety concern or anything of that nature, then yes, we can do it. And when I say extreme, I mean it literally has to be about to hurt somebody, like the stairs look like they're about to fall down or something like that. It's
Okay.
very, very, very case by case, but once again, we can pitch it to lenders and say, hey, who likes this? Who's hungry for a little bit of money today, and figure it out from there.
Okay. Thank you.
Yep. Any other questions on that?
That's exactly what happened, Brandon. Mark had a condo under contract with another lender. It fell apart. Anthony swooped in and saved the day.
Almost. We're on the home stretch here.
Yeah.
Working on Okay. And so, Anthony, one more thing really quickly, again, not trying to dominate here.
Yeah.
You know, what is when you're having a non-warrantable condo, typically, anytime I've done a non-warrantable condo for a conventional loan in downtown Raleigh, the I've had people do 5% down on a warrantable condo, but when it becomes non-warrantable, every time I've done one, the borrower has had to put down 15%. Is that about what you see?
Um, it depends on the whole profile. It depends on the project. Like this one is the one that in question we're talking about. She's only putting down 25%. So I see them up to 30%. I mean, sometimes it can be into the 40. It just depends on how bad it is. But we can pitch it to each bank. It
It's case
it
by
really,
case.
really the bank genuinely wants the borrower to be safe, and of course they want them to be safe. How much risk to reward is there? Of course, they're not going to do anything real hairy for less than 100 grand. We're not going to get a loan for that. So it has to be a substantial property, 200K plus in order for us to go down that route. But it
Okay.
non-warrantable opens, and non-QM products open a whole range of ins and outs and variables, that it's really, really case by case. So my advice would be, hey, I know this about this property. What can we do for this consumer? Let's say they've only got 15% to put down. Is there something we can do? And then we can eliminate all the showings in that range, in that property. Like, you can't get anything here. It saves you a whole bunch of time, if they want to go down that route. And I mean, in a perfect world, every consumer is pre-approved and we know their whole financial, like what can they truly afford. But I know a lot of times, hey, I want to go look at some condos, and just a first meeting, I would probably limit that to one or two if it's a project that that may have some hair, and so you can get a better idea of their financial profile. But that's a hard thing to say. I would say if someone's looking at a condo and there could be a chance of it being non-warrantable, I would say at least 20%. you know, and then that way it'll cover closing costs if you can't get any closing costs on the front end, you know. So it's really, really, that's a hard question to answer. You know, every
No, I
bank.
mean, I think, from the buyer agent standpoint, if we have someone up here who's looking at a non-warrantable condo building in downtown Raleigh, and we know based on our initial conversations with them that they're planning on putting 5% down because that's all the cash they have, it's not going to be an option for them.
No, no, absolutely not. Unless the markets change and the lender is hungry, I just that's improbable. I mean, maybe in a year we'll see what happens, but right now, no. I mean, it's worth an ask, but because it takes 5 minutes for me to say, oh heck no, or yeah, we can do something, but it's not realistic,
Thank you.
and I don't like to say no. Well, I think that covers that, but the definition of non-warrantable for everybody doesn't necessarily mean it's a bad investment. But it does mean that financing will be harder, obviously. Larger down payment, like we talked about, interest rates higher. But there are always options for non-warrantable. Non-warrantable doesn't mean we can't finance it. You know, it's as long as I put it to you this way, like I told somebody else, is like, if you think that this is a good investment for your client, chances are that we can get financing for it. But if you are questioning it and you don't feel comfortable selling it, then it's probably something we can't finance. And if you're a good person, you know, I mean, depends on how much grease is in your hair, but you know, it really, really depends on the property and is it a good investment? Because that's what the bank cared about. You know, am I going to lose my butt, or are we all going to make a little bit of money? So, any other questions regarding the loan process, upfronts, or anything like that? I mean, I could get into the nitty-gritty details, but I don't think that that's necessary. I mean, we don't have to really talk about, you know, getting the HOA's financial docs and things like that unless we feel like, you know, we're dealing with a hairy situation. But the more information we get up front, the better. And do not always trust your listings, because in that same property complex, one just went up for sale. And they put conventional FHA, VA, USDA, all that stuff. I'm like, it's not possible on that one, you know? So, you know, we have to do our due diligence before. Just like Brandon said earlier, you know, listing agents don't know the whole scope, nor do they want to disclose it. Maybe they just don't want to ask those questions, you know?
So, for the purpose of how we go about our business, now you kind of have a little bit more insight into the lending process and what the lender will need. But for us working with clients, what do you need to make sure you are doing? So, first of all, if it's a buyer interested in a condo, before you show a condo outside of the first meeting, of course, because you're trying to get in front of your client, before you start showing a bunch of condos, look into the MLS and look at other properties currently listed or recently sold in that complex. Look at the financing type and see if it was conventional. If they're all cash, that might be a red flag, right? All of that stuff is in MLS for you to look at. Look in any of the previous listings and see if they have the condo docs. I don't think I've ever sold a condo where the condo docs were in MLS. Like I've never gotten those before we got under contract. Now, that's one expectation you want to set for your buyer, is that the lender's probably going to need these, and also you're going to pay for them as part of the lending process, kind of like getting an appraisal. It's part of the cost of borrowing, right? But making sure that you're prepared to do that, but that doesn't mean you can't reach out to the listing agent, ask if they have them, if their seller has them, if they can get them, or see if any previous recent listing had them as well. All right, be prepared. And like Brandon and Anthony were talking about, I had a client looking at condos a couple years ago. I knew it was going to be hairy. Every time they sent me one they were interested in, I sent the name of the condo or the association, the development, whatever, to the lender to run it by that list first and see, you know, if it even looked possible from the outset, right? Because you're trying to provide value and save your folks time, and you don't want them to go so far down a road and then you hit a brick wall, and then they lose their due diligence money, inspections, all of that stuff, when it could have been prevented if you'd done your homework in advance. So make sure you're doing that. Working with sellers, similarly, see what else has been in MLS for recent things, but then ask your seller. Reach out to the HOA, request a copy of those. Maybe that's something you pay for as part of your services. Maybe that's something that the seller pays for as part of your services, right? It really just depends. But do the work up front. There's not much worse in real estate than a deal falling apart. And 9 times out of 10, it could have been prevented, but somebody didn't do their homework in advance. And because people get commission breath and they just want to get it under contract, right? But getting it under a contract doesn't do anything. People are happy and we get paid at the closing table. The goal is to close, not to get under contract. So make sure that you're doing your homework and you're finding out in advance, and you're using your resources like Anthony, like the MLS, et cetera, to do all the data gathering in advance so you don't hit a brick wall. Any other insights or thoughts from those of you who have done a lot of condos?
Anthony, could you share with us the document that the HOA has to fill out just for us to look over?
I was literally about to say, I'm going to send y'all a sample questionnaire.
That would be great. I'll disperse it to the team. That would be awesome.
Yep. And you can get FHA on a condo, and there is a separate guidelines for it, but you can do FHA 3 to 5%. Obviously, it's got to be a pretty awesome property, but very clean deal, which I would say 90% of condos are pretty clean, but you can do FHA. So for someone who doesn't need a whole lot of space and wants to do a condo, we can get them into the 3% down and then do down payment assistance on top of that, so that is an option too.
Also, let me mention this. And maybe it's not as prevalent at the coast. It probably isn't, but just because something looks like a townhouse doesn't mean it's a townhouse. It can be considered a condo. So don't let looks fool you. Don't assume something isn't a condo because it looks like a townhouse. There are plenty of examples in Raleigh, I know, that they look like townhouses. They're side by side, 2 stories. They're considered condos. You also need to make sure, if you're looking at a property, that the listing agent hasn't mislabeled it, right? Because I've seen these townhouses that are condos labeled as a townhouse. And then you can also get in trouble that way too, because you think you don't need to ask all these other questions or be sure. And then you get under contract and then you're like, oh, you hit that wall again. So make sure that you're doing your research. Anytime you're looking at any connected property, check out what's been happening in the neighborhood over the last 6 months or year for some context clues that might throw off red flags. And then you can always talk to Anthony about that and get his insight on it.
2 things on what Doug just said. First, if you're looking at a property in a community that's a condo, you should, on our MLS, I'm assuming it's the same at the coast, you should be able to see what the financing type was for the most recent deals, right? So if there's been 6 transactions over the last 6 months and they're all cash, the odds are there could be an issue there. But if you see that they're getting conventional loans, it could be helpful to take that information to Anthony and say, hey, 6 have sold in here over the last 6 months. They all look conventional. Can you see what you can find out? But on the listing side, if you haven't sold a condo yet, you more than likely will at some point. And, you need to disclose this stuff if you need to know it. But also, if you're a buyer agent and you get a client under contract and they sink a bunch of due diligence into a deal and then you find out later that it's non-warrantable, that's not the North Carolina Real Estate Commission. You have just as much of a duty to figure that out before the offer is extended as the seller agent does to disclose it. You can't walk back and say, well, you didn't tell me this was non-warrantable. It's your job to find that out. And so don't use that as a fallback excuse not to take the time to figure it out.
One question I have is, are townhouses similar to condos in the information that we need? Can we run into this problem with a condo and a townhouse, or is it more prevalent towards condos?
I think you can run into issues with anything with an HOA. I mean, a subdivision with an HOA that has a huge community center, and let's say they don't have enough money to cover it, or if it becomes a liability, you know, that falls back on the HOA. So, but that's very, very rare. I just think that anything with shared, anything with shared property, if things aren't in order, and the lender finds out, can be an issue. 9 times out of 10, and a subdivision with a shared community center, they're not going to have any issues. But you do run issues with safety around the pool. Let's say the fence is knocked down around the pool and the appraiser sees it, you know, that can become an issue. But as far as condos, townhomes, since there are shared units, dwellings, you know, there is more risk. Condos share the highest risk because typically they're on top of each other. So there's a lot more shared structure, stairs, things like that. So they're super cautious about the condos. And then I guess from y'all's real estate experience, I mean, you can indulge in that, but I just think we just have to do our due diligence in every regard, and you don't want to get caught with your pants down, you know.
Maybe a good rule of thumb, and not 100%, but the higher the HOA dues, probably the greater the risk, because the insurance, it means the insurance is higher. It means what they have to cover as far as structure, replacement, repair, all that is higher. When you see a townhouse with a $50 to $100 a month HOA, you're probably going to be okay. Again, not 100%, but when you start seeing $250, $300, $400, $500 a month, that's when you know the HOA has a lot on its plate to cover. And that's where you can get into risky situations, because like Anthony was talking about, well, do they have enough in their reserves to cover, you know, XYZ? And then a lot of places don't. And then that's where those special assessments come into play. And that's a whole nother ball of wax. Really good discussion. I hope this has been helpful for everybody. You know, just kind of to recap, make sure you're doing your homework up front and you're coming to the table prepared with knowledge, and to help assist, and you use all of your resources to be prepared when you've got someone looking at a condo or looking to sell a condo.
Yeah, and I think right now, especially with the competition of real estate agents, I think as much resources as you could provide your clients, the more they're going to want to recommend you, the more the experience is better and more enjoyable. And I really, really think that, you know, keeping those deals from falling apart goes a long way, because everybody's like, well, what real estate agent do you use? And if you've had a really good experience, I mean, I don't have to say this, but going above and beyond, you know, like, you know, real estate agent, yes, they're supposed to help you find a lender, but hey, I'm helping you with your next investment. I think that's the big thing now, is I'm helping you create a better future. So, especially when it comes to condos, if you're willing to say, hey, you're going to make money on this, and this is gonna provide a great investment for you, or it's a great place to live, then we can more than likely get financing on it. It's just how we go about it. But I think that's all I've got. I'll send a group email with a sample questionnaire, and this is just a generic questionnaire. There's a different questionnaire for FHA, non-QM, non-warrantable. We just have to, you know, start with the basics, and then we can go from there, because we don't want to judge a unit unless we have all cash deals or something like that. But it'll give you an idea of what questions they're asking. If you have any questions about it, let me know.
Great. Thank you, Anthony. And I'll link that. I'll add that document to our Google Drive too, and link it in the comments or the description for the video, so it's there for posterity for folks to check out if you're viewing this later. All right, Anthony, we appreciate your time. I hope everybody stays warm. Go make you a snowman or some snow cream, and be safe on the roads out there, okay? Take it easy, everybody. Thanks.
So much.
Thank you.
Thanks.
Thanks, Anthony. Thanks.